we may need to increase the policy rate further should progress on inflation stall or even reverse. As I assess the appropriate path of monetary policy, and I will remain cautious in my approach to considering future changes in the stance of monetary policy.
There's this one sentence in there that kind of has the potential, this one sentence, to completely change the economy.
What incentive does the Fed have to really do the right thing? Who really is pulling the strings behind the scenes, and what are some of the dirty money motivations out there that we should be out on a lookout for?
I think they're actually fairly independent and neutral. And a lot of people are like, oh, it's an election year, they're going to drop rates in an election year. Whenever you hear a Fed official speak, you kind of have to microanalyze every specific word they're saying. People so want rates to come down that's all the evidence they'll see. They're refusing to actually look at this from a neutral, balanced perspective of like, okay, what does the evidence tell us? All of the people making these decisions in the government and the people in the media covering these decisions and talking about it, they don't know what it's like to have inflation at 10% for multiple years in a row. They didn't erase any of the inflation of the last 5 years. That just means that inflation is just getting worse at 2%.
Real estate projects that should have never gotten a green light, but it made sense because it was 3% debt, and now people are struggling.
Buried in this four-hour YouTube video, which is, by the way, this video is like it's officially from the Federal Reserve. It's not like a hidden camera or something, right? Like the Fed posted this on YouTube. That there's this one sentence in there that kind of has the potential, this one sentence, to completely change the economy over the next year. And it's just buried in there.
It has like 3,000 views. And it's that's what's wild to me. It's like this video is just on the internet, super long. It's like hiding in plain daylight.
Yep. If you or I posted a video of ourselves twerking on Facebook tonight, it would guaranteed get more views than this video has. And it's one of the most powerful bankers in the history of mankind.
So Federal Reserve has a YouTube channel. They're hiding in plain daylight. They said something very, very, very profound that you have a lot of hot takes on. And when I'm saying you, I'm talking with Tim Chermak, good friend. We did a whole episode as they released their amazing company that's giving really the middle finger to mortgage lenders and that. And so you could talk a little bit about how this is going to impact what you're up to and how that's been going. Sure. Okay.
And while it's not my baseline outlook, I continue to see the risk that at a future meeting, we may need to increase the policy rate further should progress on inflation stall or even reverse. So given these risks and uncertainties regarding my economic outlook, I'll continue to watch the data closely as I assess the appropriate path of monetary policy, and I will remain cautious in my approach to considering future changes in the stance of monetary policy.
So that's buried at the end of like a 4-hour YouTube video. And there's one specific sentence in there that really has the potential to rattle markets. And that's where she says she'll continue to monitor. So there's like, whenever you hear a Fed official speak, you kind of have to microanalyze every specific word they're saying, because they don't just talk willy-nilly. Like, these speeches are written out ahead of time, right?
Yeah.
She's not just going up there like Trump, just rambling on, whatever's on the top of her mind, right? So she said they'll continue to monitor the increasing inflation to see if it warrants rate increases in the future. So a little context about this video. It was released about a week before we're recording this podcast, Caleb. So since then, a CPI report has come out. So CPI is the preferred measure of inflation that the Fed uses. And that report actually increased inflation way more than all the estimates. And that's been like, I think, the second or third month in a row that it's been higher than estimates. So not only is inflation not staying flatline right now, it's not staying a constant. Inflation isn't even decreasing. It's actually increasing right now. And so the backdrop of all this is that the Fed and markets were hoping in December, January that we might have as many as 5 rate cuts this year. So people are thinking that the Fed funds rate might come down over 100 bips this year, potentially even 100, 150 basis points, which would radically move the market. Obviously, that'll send stocks, way higher. It would send mortgage rates lower. I mean, obviously, lower interest rates are better for the economy. I'm saying that with air quotes for those of you who are listening and not watching. It's better for the economy in the same sense that if you drank too much the night before and you have a vicious hangover, doing shots for breakfast feels better, right? But it's painful it's painful in the short term. And the reason this is crazy is that with the exception of Jim Grant, he has said that the Fed might have to look at increasing rates. And at the time, everyone's like, oh my gosh, you're completely over exaggerating. And that's absolutely nuts, because the whole narrative has become this deal where people so want rates to come down that's all the evidence they'll see. They're refusing to actually look at this from a neutral, balanced perspective of like, okay, what does the evidence tell us? And the evidence tells us that if anything, the Fed needs to be discussing rate increases right now. And that's all she said. So we're not filming this reaction video to attack her or criticize her as much as like she's saying something that's plainly obvious that no one wants to confront right now, that if inflation doesn't start coming down, because frankly, it's going up right now, right? But if it doesn't start coming down, the scope of the discussion at the FOMC is going to have to shift from when are we cutting rates to how much do we raise them? Because what they want to avoid is a 1970s decade of stagflation where, you have elevated inflation literally for a decade. The last rambling point I'm going to make here is that videos like this and reactions, people are already just attacking Michelle Bowman in the media, saying that she's way too hawkish. She's, it's risky even saying things like that. You shouldn't talk about things like that. It just shows how out of touch a lot of the financial elites are from the average American. And by the way, to preface what I'm about to say, I own a marketing agency that specializes in working with real estate agents. We have about 250 clients across the country in that marketing agency. I also am a partner in a mortgage brokerage. Both of those businesses benefit like disproportionately from a lower interest rate environment. Right? So I almost more than anyone should be rooting for lower interest rates because it personally helps me, more than anyone. Like my businesses will show more profit with lower rates. And yet I completely see what Bauman is saying here, in that, hey, the evidence, let's just say it out loud, right? The evidence seems to indicate that we might have to discuss raising rates. And so why I think that's crazy, to finish that thought, or why I think it's crazy that she's been criticized for saying that, is that financial elites live in a social and economic bubble where if you work for the Fed or you work for CNBC or Fox Business or Bloomberg or really any financial institution or media institution that covers the financial world, you probably make $100,000, a couple $100,000 a year. You might be making $1 million a year, right? Once you get in the United States above 150,000 in household income, it obviously depends where you live, of course, but in general, 100 to 150,000, you stop worrying about the price of groceries. For the most part, you stop worrying about the price at the pump. You're not worried about making your mortgage payment or if you have money for rent. Like at that price point, if there's inflation when you go out to eat, it's more like annoying, but you still have money to go out to eat. You're not looking at the menu when you go out to eat. Yeah,
inflation's not one of those. I also think inflation's one of those things that doesn't hurt you today. And so it's less prevalent.
It's really helped that class of people who owned assets because their assets went up, like me or you or people who owned real estate or things, like if you owned a house before the last 5 years, that house may have increased by $500,000 in value. So it really doesn't bother you if groceries are more expensive or whatever. It's like, that's not really on my radar if you make that much money. But the point I'm making is that all of the people making these decisions in the government and the people in the media covering these decisions and talking about it, they don't know what it's like to have inflation at 10% for multiple years in a row. Because let's be honest, when they say inflation's 3%, it's like, have you bought groceries lately? Have you tried to buy a car? Have you tried to pay rent? The hidden in plain sight insight here that I was kind of getting at, where there's not really conspiracy, like all these things are hidden in plain sight, is that when they talk about, oh, inflation's coming down to 2%, we're trying to get inflation down to 2%, right? They didn't erase any of the inflation of the last 5 years. That just means that inflation is just getting worse at 2%, right? So if
it's not like we're looking for reverse inflation.
Yeah,
like,
there's not deflation happening. And so that does absolutely nothing for a poor or working class family who barely can afford groceries. They barely can afford to buy lunch for their kids at school, or their 9-year-old has been wearing the same pair of shoes for 2 years in a row because they literally can't afford to spend $50 on a new pair of shoes, or they barely have money to fill up the tank of gas. So they really can't look for jobs because they can't afford the basic necessities of life. When you hear these politicians and media analysts talking about, oh, inflation is stabilizing at 3% and the goal within the next year or two is to get it down to 2%. They're not lowering the price of anything. They're just slowing the rate of the growth. And so they're completely ignoring how many people are really, really damaged in the economy by inflation staying as high as it is.
Yep. Quite a couple questions for you. This is a raw reaction here. What incentive does the Fed have to really do the right thing? Like, I know that people think that they're political, and they say it's hard for me to say, like, this is really not a political arm, but that's kind of like, I'd say that tongue in cheek. What do you think incentivizes the Fed, and does the president, do these parties, like, who really is pulling the strings behind the scenes, and what are some of the dirty money motivations out there that we should be out on a lookout for? So
again, I don't think there's as much conspiracy here in terms of like some secret society like Yale Skull and Bones, where they get together and worship Satan and then they plan the monetary policy for the country or something, right? As much as like they're trying to get inflation down to 2%. And there's some people who have philosophical differences of how do we accomplish that? How long do rates have to remain elevated? There's doves and hawks on the FOMC board. There's 12 members of the FOMC board, made up of, I think it's like the 8 Fed regions plus 4 other voting members. And Bowman is one of those members on the FOMC that is that makes these decisions on where they're going to put interest rates. I think they're actually fairly independent and neutral. And a lot of people are like, oh, it's an election year, they're going to drop rates in an election year. It's like, there's really honestly not historical data that shows that they often cut rates in an election year. Because if they cut rates this year, right, it's not because it's an election year as much as like, well, it came time to cut rates based on the data and it happened to be in an election year, right?
Yeah.
I mean, you could say the same thing about the midterms 2 years ago, that they didn't cut rates. And they actually jacked up rates.
Trump has been in a way a disaster when it comes to like wanting to lower the rates, and he doesn't, but he put so much pressure during COVID for that. Did he have any influence, or is it just him?
Now, Powell was appointed by Trump, and Powell is a conservative Republican. He's a known registered Republican. Like, that's not Tim's libertarian conspiracy theory. It's like, you can Google it. Jerome Powell is a registered Republican, right? He was appointed by Trump. So he's not like a super left-wing, a progressive, modern monetary theory, Fed chairman. He's not nearly as a progressive in his monetary policy as, Yellen or Bernanke or some others. But I think the Fed is more neutral than people probably realize. However, they have to react to the reality of the economy and the capital markets and the American debt situation. So if Congress keeps spending just $1 bajillion, every year, trillions in deficits every year, right? And that, puts upward pressure on interest rates because investors have to buy those treasuries, right? The Fed has to react to that environment. Like, they're not operating in a vacuum. And so at a certain point, they have to look at like, okay, well, with all this deficit spending, that's pushing inflation potentially higher. So it's not that they don't pay attention to politics, like they do, because if politicians are spending way too much money, that affects the environment in which the Fed is trying to do its job, which is get inflation down to 2%. So I don't think they're super biased the way that some people accuse them of, as much as they're in an impossible situation where it's like the Fed is a high school driving instructor and they're driving a student driver, and the student driver in this example is Congress, which doesn't know how to balance a budget, and the student driver is in the back seat, or the driving instructor's in the back seat, and the student driver is drunk. I mean, there's no possible way they can take control of the car, because if the Fed were in control of Congress, I think there's a decent chance they might balance the budget. Usually bank presidents are just in general more fiscally conservative than a member of Congress is, because they understand a bank can't just run a deficit, and a bank has to have capital reserves, and has to be solvent, right? So that affects everything too. That'll probably be the biggest story, Caleb, over the coming years in the next decade, is how the Fed responds to rising interest rate pressures because of U.S. deficit spending. I mean, right now we're going trillions of dollars in debt every year, and the interest is getting scary because at a certain point we can't finance the interest.
And my question is, higher interest rates kind of affect the government big time, because so that's a thought process. There's people out there that are saying interest rates have to come down because when you look at the debt. Would love to hear your thoughts on that. And then my second question is interest rate. So inflation really hurts everybody, but really affects the lower class. But wouldn't higher interest rates also affect them, because it's all a ripple effect? If real estate investors now are refinancing their developments at 9-10%, isn't that going to pass down via higher rents?
Yes and no. I mean, don't get me wrong. Lower or higher interest rates aren't fun, economically speaking. Like, no one enjoys that, right? Except for maybe people who are retiring that want more yield on their portfolio. But higher interest rates, can really put a stop on the economy. It can slow things down real quickly. But the question is always compared to what, right? Compared to the alternative of inflation and the economy never truly healing. It's not going to be fun, but there is an upward limit on what you can charge for rents if there's high unemployment and people are losing their jobs and they can't afford to pay rent. So that's kind of what regulates that in a free market. So I mean, frankly, I think at this point, like, I'm not in the business of making predictions. Like, I don't want to go on here and say, hey, the Fed's gonna raise interest rates this year. But at this point, what I would say is it's probably more likely that if the next inflation report that comes out next month, if the CPI is still elevated, it's more than likely that we'll see a rate increase in 2024 before we see a rate decrease. There is a lag effect that usually takes 12 to 18 months. And so we technically haven't seen the full impacts of some of the rate hikes, because it was less than 18 months ago that they hiked the last rates. It was actually I think the last one was last summer. So maybe in the next coming months those will start to kick in, but like, so far the data isn't good. I mean, we're seeing, again, inflation's actually increasing. It's not even staying the same. It hasn't flatlined. It's actually increasing.
And I think the point that you made was really profound. We're not factoring in the disaster that COVID was. We're literally just talking about now, and I don't have a good analogy that's coming to my mind right now, but it's like we have a big problem that we're just kind of like, we think if we just get to 2%, it's all going to be good, but we forget the disaster that was our past. And so it's
because all of that inflation of the last 5 years hasn't gone away. Like, those prices are still elevated, and for the most part, people's wages have not kept up with that, at all. And so groceries are still as expensive as they ever were. Gas, everything is still as expensive. So, if you owned a house and you had a big portfolio and some businesses, like, your balance sheet might be way bigger than it was 5 years ago. So there's a wealth effect.
Yeah. I'm with you. I know that you have a lot to gain with interest rates coming down. I think it's really, I think it's special for you to say, here's my personal bias, but to be honest, this is the right thing for the economy, because overall everybody loses if inflation gets out of control. For me, I'm excited because I don't like being in business. It's just you just have to be better. And with low interest rates, you could be a dumb investor.
Absolutely.
There's some real estate projects that should have never gotten the green light, but it made sense because it was 3% debt, and now people are struggling. And I just think it's going to make people better, and hopefully it takes some of the dumb money that's floating around and eliminates it. I don't know if you have any final thoughts, but I know you didn't necessarily make predictions, but they're hiding in plain sight. And it seemed, because I watched her, I watched more than I want to admit of this lovely lady speak on stage, and she wasn't very optimistic. She talked about inflation a lot, and she even said about maintaining, increasing. She didn't say anything about decreasing. And so again, I don't want to put words in her mouth. I don't want to attack her. I kind of feel the same way. I hope they do the right thing and they don't just continue to play for today. Like, I love the fact that someone's thinking hopefully long term. But I don't know. What are your final thoughts?
So what the Fed is trying to avoid, Caleb, here is a repeat of the 1970s, where in the 1970s we had crazy inflation when they took the US off the gold standard in 1971. And the Fed made the mistake several times where they thought they had inflation kind of nipped, and they took their foot off the gas and they lowered rates a little bit, and then inflation came roaring back. And so it was this yo-yo of stagflation in the 1970s that essentially lasted an entire decade. Powell has referenced this several times in his talk. So this isn't me, thinking, I wonder if they're aware of this. Like, Powell has referenced this in his official Fed talks, that we've studied what happened in the 1970s, and our main objective is avoiding, the monetary policy mistakes that the Fed made in the 1970s. And so if he's not lying, when he says that, that would seem to indicate that rate increases are definitely on the table, because when you get several months of data in a row where the CPI is actually increasing after the, elevated interest rates we've had now for over a year, maybe they didn't raise them enough, and they do have to increase them more to kind of finally extinguish inflation. It's like inflation right now is like when you put out a bonfire at night and it's mostly out. There's a little bit of embers blowing, but if a strong wind comes by, the fire could they need to walk over with, a bucket of cold water and just douse it. And so I'll end by saying this. I don't know what they're going to do. The Fed will basically never get in trouble for keeping rates where they are, because no one can criticize them if they just keep them where they are. So that's the politically safe thing to do that shields them from the most criticism. But if I was a voting member on the FOMC, I would vote to raise interest rates probably 50 basis points, not even 25. Because I think if they did that, it would probably extinguish inflation once and for all. And it would actually lead to interest rate cuts sooner than if they keep doing what they're doing, which is just keeping the rate constant and crossing our fingers and hoping and praying that inflation comes down. Because that should be the goal, is like, we got to extinguish inflation as quickly as possible. And if it were me, I would actually be putting a 50 bip increase on the board. That doesn't have to last for a year. It could probably do its work in 6 months. You'll have to Google this, Caleb. I forget the name of the economist, but there's an effect. He won a Nobel Prize actually back in the 70s or 80s. I'm just blanking on his name right now, but he observed a rule in kind of macro monetary policy where the Fed is constrained in its open market operations by the expectations of the market. So essentially, if the market expects them to do something and then the Fed does it, it really has a neutral effect, because the market was already pricing that into its plans. And so his theory was like, the Fed has to keep that in mind. And the only thing the Fed can do that'll actually change outcomes more than what the default would have been is if they do something surprising that no one saw coming. Then it actually has a net effect. But anything short of that doesn't really move the needle if people are already pricing in what they think they're going to do. The Fed has to keep that in mind, that if no one's expecting them to raise rates, but inflation keeps going up, well, now's the perfect time to actually raise rates. As much as that would be bad for my businesses and bad for the real estate market, and they would come under a lot of criticism for doing that, it's probably the right thing to do if they actually want to get inflation under control, because right now no one expects them to raise rates. So if they did it now, it would actually have the impact of really slowing down investment and the velocity of money, and thus inflation. Inflation would probably come down over the next year, and that's what we all want, because when inflation comes down, then they cut rates and the party seems fun again.
Yeah, and here's what I love about our conversations is you have opinions about a lot of things that are not just Tim's thoughts, but like a lot of it is backed by, you do a lot of reading and you know your stuff. What would happen if someone just raised interest rates like double? Like, just a thought experiment. Like, what would happen, and what do you think would happen if the Fed was just like, you know what, screw it, doubling? Like, would our economy just like, would it be like an economic atomic bomb?
It would if they doubled rates. I mean, I think they're are they in the 5 point something as the Fed?
5.33%.
Yeah, so it's in the fives. Yeah, I mean, if they doubled it to 10, it would cause a Great Depression, because people don't realize at like the highest levels of finance how thin a lot of margins are. That entire industries are based on very, very small spreads, and if you double that interest rate, it doesn't mean all other interest rates are cost double. It means that some other things can triple or quadruple.
Yeah.
And so, I mean, that would just put a lot of industries and businesses out of business. Not literally overnight, but a lot of businesses would fail within 90 days if they did. So that would be catastrophic.
The dance between, you raise them too high, it's catastrophic. You raise it too low, you get runaway inflation. And that's where you're saying, unpopular opinion, but you're just like, hey, raise them up a little bit. The market doesn't necessarily expect it. It's gonna have a greater effect. And then the hope is that you can lower interest rates. Obviously, that's great for business. How low do you think we can go? I know that we've talked on the phone before, and you're like, we're never going to see 2% again.
Yeah, I mean, if you're asking me, Tim, what's your opinion here? What would you do? This is where I insert the preface that if Tim was in control, we would not have a Federal Reserve, because I would let the free market set the price of money and capital in the economy. It's actually illegal in any other product or industry to price fix, for someone to set prices from the top down. Like, that's what we have the FTC for. The antitrust, like legislation, and because price fixing is illegal for any other product, service, or industry. And yet for money, the most important product or service in the economy is the literal money supply. Like, what's the price of capital, right? The price of time. The Fed sets it from the top down. So it's like, we believe in capitalism for everything else in the economy except for literal money. We're socialists.
Yeah.
So I would not have a Federal Reserve at all. If I would let people determine, hey, if you're willing to, if Chase Bank or Wells Fargo or Bank of America is willing to loan mortgage money out at 5%, well, I guess that's the mortgage rates are 5%. Like, we don't need a Fed funds rate determining what all the other rates are. The free market would figure it out. I mean, look at the price. To answer your question, look at the price of non-government guaranteed, like uncollateralized debt. So in other words, like credit cards, right? Mortgages are already like backed by the federal government. If it's a conforming loan, obviously it's guaranteed by Fannie, Freddie, and they're packaged up into mortgage-backed securities. And there's a certain amount of risk. There's a risk-free nature to buying products like that. But if you do a peer-to-peer loan on like prosper.com or LendingTree, or you have a credit card with American Express, or those rates are sometimes 20% plus. So that's what kind of tells you, hey, in a free market where people are lending their own money and there's a risk of default, what yield would they ask for? Like, what risk adjusted return would they need in this current market if you're going to loan out your money? It's like, well, if I approached Caleb and I was like, hey, Caleb, I know that you've got a pile of cash. I want to buy a house. Will you loan me money for 30 years at 4%? There's no way on God's green earth that you and April would loan me money for 30 years at 5 or 4% or 3%, what all these people got mortgages at, right, over the last couple of years. So that tells you that the government is setting the price way too low for that, which obviously pushes up asset prices if the money is cheaper than it should be. So, I mean, if I was running it, I would try to abolish the Fed because it causes so much, so much financial calamity, frankly, that we wouldn't have these crazy ups and downs if it weren't for the Fed micromanaging all that policy from the top down. Like the reason we're in this mess is because they kept rates way, way too low for too long during COVID, because they were so afraid of a depression. It's like, well, maybe if you didn't pay half the country to stay home and not work, you wouldn't have had to do that. But I just need to protect my libertarian street cred, Caleb, and say that if you're asking Tim what he would do on monetary policy, it's I would dynamite the Federal Reserve building.
And with that, I think that will be a good way to end this. And we'd love to hear your thoughts. What are you going to do with knowing that interest rates may stay the same or going up? Obviously, we're not giving investment advice or predictions, but it's interesting just as someone who wants to make moves. It's interesting to have an opinion there. And then do you have questions? Are there things that we should be looking into?
I'll just say that in a higher elevated interest rate environment, that's just a different way of saying a lower profit margin environment, right? When you hear like elevated interest rates, it's just a different way of saying lower profit margin. And a lower profit margin environment means that you will have less competition, because it means that your competitors who could get by and survive when times were easier can no longer get by because they maybe made dumb management decisions. They kept their expenses too high. They hired people they shouldn't have. They spent marketing money on dubious, investments that didn't have a return. They invested too much in fixed investments, increased their fixed costs too much. They were just not running an efficient business, right? Those people die by the wayside if rates go up and the economy kind of slows down, because low interest rates are no longer subsidizing their lack of intelligence. Right. So if you think of yourself as a smart business operator, and I like to think I'm moderately intelligent, Caleb, you're obviously extremely intelligent. It's kind of exciting thinking that, okay, the economy will suck over the next 6 months or the next year, because it means we'll have less competition, because I'm confident in my ability to run an efficient business, even in non-ideal circumstances. Like we can still figure it out, make it work. We can get our clients results. A lot of people can't. So it means that you'll have less competition, and the herd gets thinned, when that happens. So does it suck? Yes. I'm not trying to make it sound like it's awesome, right? Like it sucks, but that's the silver lining, is that you'll have a lot less mediocre competition when all is said and done.
It also highlights value of liquidity and control. I mean, it's just like, what's the value of having access to capital? Could be higher, especially if access to capital costs some people 12%, and you have access. It just creates a greater opportunity cost calculation across the board. And it goes back to the psychology of money. The rate of return of zero can still be greater. And obviously in a high interest rate environment, your savings accounts are paying 4, 5, 6%, which that alone is cool. But the liquidity and control is something that I think hopefully people over time see the value of, because I think there's so many people that want to put their money in places, and as interest rates potentially stay the same or go up, there may be volatility. And it's interesting to me about the value that people put on control, and how you value control. Let's take a 30-year picture. I would love to actually look into that more, as like your value of control compounded over 30 years. I would just wonder the people that have a high emphasis of control and liquidity versus people that have a low emphasis. I'd just be curious how that would pan out over 30 years.
If it's going to be tough to run your business in the next year or the next 6 months or whatever, because rates will be elevated, this probably sounds heartless, but you might need to like reevaluate if you're meant to be an entrepreneur, because I have news for you. With the rate at which Congress is spending money and the deficit grows and grows and grows every year, the future is going to be defined by higher interest rates, not lower interest rates.
Yeah.
Right. Like all things being equal, lower interest rates are not going to be like the new normal in the future. It's going to be higher interest rates will be the new normal if we're ever going to get this debt and deficit spending under control. So if you don't know how, or you can't figure out how to efficiently run, you know, a business or manage your household in higher interest rates, like, you better learn quick, because that is honestly that's the new normal that people need to be aware of. We're just lucky that we live in the United States where, you know, due to dollar milkshake theory, we kind of absorb a lot of the liquidity of the world. So when we do stupid things, we get to, you know, suck up all the capital from the rest of the world that essentially subsidizes our bad decisions, because people buy US treasuries when they're uncertain. So, you know, that kind of cushions us a little bit from our dumb decisions in Washington, DC, but it's still going to be difficult, you know, so you need to be confident that you really know what you're doing if you're running a business, because I heard a great speaker at a conference a couple months ago saying that if you launched a business starting around, you know, 2010-ish, like if you've been in business for the last 15 years, you've only ever known a growing economy, because the economy overall, like not industry specific, but just overall, the economy was better in 2011 than it was in 2012. It was better in 2012 than it was in 2011. It was better in 2013 than it was in 2012, and so on and so forth. Essentially, for the last 15 years in a row, every year the economy grew and things were better. So if your business was growing slowly but steadily during that time, you might have tricked yourself into thinking that you were a talented entrepreneur and like, wow, I really know how to run a business. When in reality, you were just floating on a strong current. You weren't rowing or anything. You weren't steering a ship. The current was just taking you. And now that things are set to contract, potentially rates are going up, it becomes difficult. Now you really see, was your business ever actually that stable? Is there actually demand for what you're selling at the price at which you can profitably sell it?
It's good.
You know, because in the last 15 years, you were kind of living in a giant false positive where idiots could make money because the economy was just growing every year, you know? So we'll see, you know, over the coming year or two here, who was swimming naked.
And to put a silver lining on the whole thing, your real estate marketing company, it's going to put a greater emphasis on being better at marketing, because the majority, the 80% of people that got their license because everything's good and you'll just hit up your friend, that they're all going to go away. And so there's a world where the good ones will stay around and thrive because competition goes out.
Absolutely.
But that ultimately it is again good for business if you actually help them and you have a good value proposition. Mortgage company is going to be a whole nother story, but you're, as interest rates go up, they're going to be even more price conscious, and you're essentially saying we're doing flat mortgages, and at the end of the day, you're going to be able to crush other people who are making a greater spread. Do mortgage lenders make more money with higher interest rates? Like, do their fees get higher on that, or how does that work?
No, they don't make more money per se. If anything, they often make less money, because when rates go up, you know, transaction volume goes down. So people are buying less houses. So they get really competitive, and they usually start, slashing their fees and rates to try to win loans, where when rates are low, people don't really shop around as much. So lenders can get away with charging extra unnecessary fees and higher spreads. But usually a mortgage lender's comp is based on the actual home, or the actual loan amount. So it's like they'll make double on a $600,000 mortgage what they do on a $300,000 mortgage, and so on and so forth. With interest rates going up, if anything, they make less money, because again, they, you know, the buyers are much more sensitive to price, so they start dropping random fees that they were charging before, hoping you would never notice. Like, one of my favorites in the mortgage industry is the origination fee that a lot of lenders charge, and the origination fee can be anywhere from $1,000 to, I've seen it as high as $2,000, and it's just a completely arbitrary fee they tack on your closing cost. No one ever questions it. It's there for no reason. It's just extra money they make, and they're hoping you don't call their bluff that they charge a origination fee. It's basically the equivalent of a setup fee, or it's just an extra fee that if someone calls them out on it, they can dangle it in negotiation. We'll get rid of the origination fee. But if no one asks them, then they just make a couple extra $1,000 per loan, because most people don't read line by line items on their closing statements, right? They just pay whatever the person tells them to pay. So that's one thing that we're proud of doing, is our origination fee on every loan is 0. Because I feel like if it's there for completely arbitrary reasons, let's just get rid of it every time and explain to consumers that, hey, other companies will try to kind of like secretly charge you for this and hope you don't notice. I'm just telling you, we're not charging you that. So even if another lender comes in with a rate quote that seems like it's as good as JGMC's, or maybe even a little bit lower, ask them like, what's their origination fee? Because often companies will kind of do teaser rates, but they're making up the money elsewhere somehow. So
we'll do let's have you back on and let's talk about the dirty secrets and the must knows if you're going to get a mortgage. Like you've learned a lot, and it would just be beneficial even if it was in like a slide deck format of like, here are the things that are must knows. And I think for our audience, regardless if they can work with you, if it's a state that you're in or not, it would just be super helpful. I know for myself, I didn't know what I didn't know, and I'm more educated than the average person around this kind of stuff, but there's certain things that if you just don't know, you just don't know. So
yeah, man, that'd be fun. I will make a lot of friends in the mortgage industry by doing that, but it would be fun. Just
like I make a lot of friends in the insurance space. So, we'll get right along.
I think that's why you and I have become friends, because we have no other friends in the industries we work in, because everyone hates us. So that's why Caleb and I are friends.
And on that note, guys, take care. We want to hear from you in the comments, and type your questions down below for next time Tim comes on. You can tell he's a big thinker. So Tim, thank you.
Yep. Thanks, Caleb.